Today, we're going to dive right into a financial puzzle that honestly trips up so many of us. We're demystifying exactly why the words debit and credit mean one thing at your local bank and something entirely different in a bookkeeping ledger. So think about this universal confusion for a second. If a credit on your personal bank statement feels amazing, why does a credit to cash in accounting mean you just spent money? It sounds totally backwards, right? Well, it really all comes down to perspective.
Let's start with everyday banking. The rules here are super familiar, mostly because they're personal to you. Basically, a debit just takes your own funds out of your account. A credit, that adds money in, whether we're talking about a deposit, a nice refund, or a transfer from a friend.
To put that into perspective, think about your last trip to the grocery store. You tap your debit card for, say, $50. Boom, your checking account decreases by that exact amount. It's just money out. Simple enough.
But on the flip side, what happens on payday? Let's say your employer drops a $2,000 paycheck into your account. Your account is credited. It increases by $2,000. Money in. We absolutely love to see it. Now, let's step inside the corporate accounting department. Here, debits and credits aren't inherently good or bad. They're literally just bookkeeping tools used to balance a very basic formula. Assets equal liabilities plus equity. Every single transaction must have at least one debit and one credit of equal value just to keep that giant scale perfectly leveled. And this right here is where the total paradigm shift happens. In accounting, debits actually increase your assets and your expenses, but they decrease literally everything else. Credits, conversely, increase your liabilities, your equity, and your revenue. So it's an entirely different system of logic than what your personal bank teller is using. Let's actually look at this crucial difference in action. Imagine a company buys $1,000 worth of equipment in cash. Well, you debit the equipment, which is an asset, to increase it. But because you paid with cash, you have to credit the cash asset to decrease it. One goes up, one goes down, and the whole shebang stays perfectly balanced. So just to summarize this shift for you, your everyday bank account treats a debit as money out and a credit as money in. But in the accounting world, you gotta remember this golden rule. A debit isn't always a bad thing, and a credit is definitely not always a good thing. They are simply two sides of every single financial transaction.
Now, to keep all this straight in your head, accountants actually use a really handy cheat code. It's called the dealer method. DEAL. Stands for dividends, expenses, and assets, which all increase with debits. Then you have LER, liabilities, equity, and revenue, and those all increase with credits. Honestly, just memorize dealer, and you'll pretty much never mix these up again. Armed with this dealer method and the actual truth behind the accounting equation, it kind of completely changes your perspective, doesn't it?